It is bond Royale for domestic fixed income, with India being included in the JP Global Emerging Bond Market Index. Inclusion in the index will be staggered over 10-month period, starting June 28, 2024, through to March 31, 2025, that is, inclusion of 1% weight per month. In the event that India is also included in the other global emerging market bond indices, the estimates for total foreign inflows are in the range of $35 to $40 billion. Inclusion in the JP Bond Index is likely to have a positive effect on current account deficit, INR, fiscal deficit, and long-term bond yields. India's CAD is now expected at 1.3% of GDP in financial year 25. Service exports have been exceptionally stable at high level, providing necessary cushions to rising merchandise-led deficit. Expect INR to average between 83 to 84.6 per USD in financial year 24, as well as financial year 25. FPI debt inflows, amounting to at least $18 to $22 billion, owing to index inclusion, would imply an additional demand for G6, amounting to approximately Rs 1.4 to 1.8 trillion, during June 2024 to March 2025. An additional source of demand amid lower supply of G6 would aid in comfortably financing the fiscal deficit, and would augur favorably. Index inclusion announcement would provide a cap on bond yields in the interim, and could lead to some easing of yields once inflows on account of inclusion begin starting June 2024. Currently, FIIs own less than 2% of central government debt, which is likely to increase going forward. Going forward, we recommend to increase duration in the fixed income portfolio, so as to capitalize on the softening of yields in medium to long-term period. 65% to 70% of the portfolio should be invested in combination of high quality, like GSEC and AAA equivalent roll-down strategies of 7 to 12 years maturity funds, and equity savings funds, which aim to generate enhanced returns than traditional fixed income, along with moderate volatility through a combination of equities, arbitrage and fixed income instruments. To improve the overall portfolio yield, 30% to 35% of the overall fixed income portfolio can be allocated to select high-yield NCDs, private credit strategies and REITs in VITs. For liquidity management or temporary parking, investments can be allocated to arbitrage, ultra-short-term, minimum 6 months, liquid, 1 to 3 months, overnight, less than 1 month, strategies. India's contribution to global market cap is at its all-time high. In terms market cap to GDP ratio, India is reasonably valued, as compared to the US. On a trailing valuation basis, the Nifty 50 and Nifty 500 index appear to be more attractively valued than the Mid-Cap 150 index. When we look at the ratio analysis, the Mid-Cap 150 to Nifty 50 ratio is currently at its highest point, whereas Small Cap 250 to Nifty 50 ratio still looks reasonable. Earnings growth is expected to be steady going forward. BFSI and auto are likely to drive earnings growth for Nifty 50 in financial year 24. The current temperature index suggests large cap valuations are at the fair value zone. For incremental investments, we continue to suggest 50% deployment immediately and 50% to be staggered over 3 months, while being able to accelerate deployment during sharp corrections. Based on trailing 12 months earnings, temperature gauge index suggests that large cap valuations are still in fair zone. We recommend to adopt a complete staggered approach for select mid and small cap strategies across MF, PMS and AIF platforms.